Okay, let's invite Sandip Agarwal, fund manager, Sowilo investment managers on the show. Sandip, numbers were not exciting, but a 10% fall in the stock price? Is that a bit excessive? How would you read the reaction?
Good morning and thanks for this opportunity. As you know that, markets always discount the future, and if, as you rightly mentioned, the future looks little weak for HCL Tech because one large program is coming to an end and the implied guidance implies negative. And let me tell you, this when these large programs come down, it doesn't impact only 1 quarter, sometimes even 2 quarters. And on top of that, this stock has massively outperformed in last few months. And not only this, even many tech stocks have outperformed in a very big way. So this was bound to happen. We have been saying on every media interaction in last 2 months that all positives which can happen in the sector are priced in, but whatever negative can happen, that is not at all priced in. So I think still that, except for ER&D, which could be a structural play, and you may see time correction even there for 2 years, all other IT services companies are very expensive right now, particularly because this is a matured sector where more than 7-8% growth on a structural basis is difficult. And with some margin improvement, you can see 11-12% kind of PAT growth, also aided by buyback of shares. So it is a very stable structural sector where PEG ratios could be high, what you assign, but then beyond a point, this sector is not a very high growth sector. You can assign very high multiples. So always price to perfection.
So you're saying the IT services companies, large cap especially, are priced to perfection, valuations are rich, and growth for these companies will be in mid to high single digits, not a double digit kind of a growth?
See, the smaller companies can have double digit growth, low double digit or mid teens kind of growth, but the large companies on a long term basis cannot have more than mid to high single digit growth. There will be, and it is very simple sector because the budgets are decided globally, everything is on there, so there is nothing to even much analyze. So for example, during COVID, what happened? 1 year there was no growth because of whatever happened, and then next year there was double the growth, so it covered the previous growth also, and people started extrapolating on that growth. So I think that is a challenge. So this sector structurally is a 6-7% global IT outsourcing growth. We gain some market share, we do 8-9, and our companies can do 1% more. So it cannot be more than that growth, and some improvement on utilization, some metrics, refinement, some operating efficiencies, you can do see 12-13%. But more than that, PAT growth is not possible. And for that, you should not breach 25-30 times multiple at all, even if they distribute a lot of cash. So whenever that happens, then the stocks come down. And whenever the multiples go below 18 times, 1 year forward, the stocks recover very sharply in a short span of time.
Okay, Sandip, what's the expectation specifically in mid-cap ITs? Where do you think the outperformance will come in from?
See, in mid-cap, the advantage is that, they don't have a backlog of a very huge base. So for them, every small deal or a small deal can make a big difference. And within the mid-cap, there are two kinds of players. One is ER&D, where, growth will be 2.5 times of IT services growth for next 10 years. So where, you can assign a very high multiple of 35-40 times also. And in 2 years, you will see that multiple becomes reasonable. So you have to invest at right time. There is another sector, which is IT services within the mid cap, where growth will be better than the large cap. So they can do 13, 14, 15% growth and maybe PAT growth of 18, 20% because there are a lot of inefficiencies which could be covered. But there again, if the PE multiple is more than 35 times, it is very difficult to justify. So I will suggest that, we have to be very cautious of valuation in this sector. That is the only thing which keeps volatility in the stocks. Otherwise, this is a very straightforward sector. Everything is reported. You can make out everything. The only asset in this industry is manpower. So if you track the attrition right, I think you don't need any advice also. It is so simple. The attrition is always a precursor to what is going to happen. For example, in this quarter, I am seeing some trend of attrition going up. That means growth will be good again in next 3-4 quarters. But at the same time, the stocks have moved up much faster than that. So price correction or some correction because of valuation could be there. Revenue numbers will not disappoint next 3-4 quarters, and margins will also not disappoint.
So what's the appropriate valuation? You're saying valuations are expensive right now, given the kind of growth, the mature growth we expect from the IT companies. So what would be the right valuation to ascribe to CA TCS, Infy, HCL Tech?
So between 20 times to 30 times 1 year forward is, I think, a right valuation, depending on the company, depending on their cash distribution. And for the mid cap, which are growing faster, again, similar multiple 20 to 30 times range. And for ER&D, you can go up to 35 times because that industry will do much better than the IT services in long run. So
But
that is the
HCL
way
Tech
to look
value,
at it.
but HCL Tech has now gotten a bit derated after today's fall. So is it attractive now, or does it need to fall a little bit more before valuations are comfortable?
So Reema, I will give you one data. HCL Tech, and I am no more an analyst, so pardon me, and I run a PMS, so I can't speak on a particular stock. But let me tell you, it is one of the best performing stock in last decade. If you see the data, they have given phenomenal returns. So these are good opportunities. I am not saying 1800 is a good opportunity or not, but in long run, these companies are decent. They will give you returns. So you have to buy right at the right price. So if you buy them at a very expensive valuation, then obviously you will go through the pain.
But IT is also seen as a bit of a macro trade. Defensive when domestic earnings are slowing down. There is the rupee tailwind. So how do you marry high valuations, moderate growth with this macro trade?
So, Reema, the challenge is that, we always give a lot of credit to rupee depreciation, but if you see practically all the companies are hedged, right? So you don't get, and we have done this analysis a lot in the past, the benefit of rupee depreciation is very minuscule to the actual earnings of the company. Yeah, it gives some benefit on the INR growth, which no one actually tracks. So I think that is little overhyped. And now second thing is that we are dependent on global macros. So global macros are looking okay. Let's say Trump coming in, corporate tax cut will lead to revised discretionary spend and all that. My challenge is that, everything positive what can happen is already built in the sector. But Trump being Trump, you never know how he can increase the cost of doing business. And that is not at all priced in the sector today. So I am little worried on that front. So my view is that we should always be very cognizant of what we are paying for what. And to me, it looks like we are paying little too much than what we will be getting in next 12 months.
So what are you recommending to your PMS clients in IT then? Or is IT generally not a part of the portfolio?
I will not say that it is not a part of portfolio. We have very selected mid-caps which are there. We do very bottom-up work on that front. So whatever is reasonably priced and we see a 5-7 year opportunity, we buy those names. Right now, IT is not a blanket buy like it was last year. So last year, October, November, when most of the large companies have withdrawn their offer letter from the campus, they have postponed the bonuses, hikes. I think that was the bottom, and that is the time we were all in and very, very bullish on the IT. Now we are not in that situation.
So the overall tech exposure in your portfolio has come down? If yes, from what levels to what?
It has almost reduced by 50-60%.
50-60%. Okay. Thank you very much, Sandip, for joining in. Sandip, truly, like a year and a half back, he was so bullish across the board in IT, and now he's turned a bit cautious. And the tech
That's why the reduction in, I think, the 50-60% reduction from the portfolio he was holding and coverage for the IT side.
Indeed. We'll slip into a very short break on that note. We'll come back and discuss commodities. Manisha Gupta joins in on the other side.